There are moments in the global financial system when multiple signals begin flashing at the same time, signals that most people ignore until the move has already happened. Right now, the conversation around silver is heating up again. Headlines are talking about pressure inside the COMEX market, geopolitical tensions affecting oil routes, and major economies like China making strategic moves that ripple across global commodities. When you combine these forces together, you start hearing one question everywhere. Could Monday bring another surge in silver? Not hype, not predictions, just the possibility that the market may be approaching one of those moments where attention suddenly shifts. Because markets rarely move in isolation. They move in response to pressure. Pressure in currencies, pressure in energy, pressure in global confidence. And when several of those pressures appear at once, the metals market tends to wake up. The title, Silver Pump Monday? COMEX Crash+, China Goes Nuclear+, Iran Oil Hit. Sounds dramatic at first, but beneath the dramatic language are real themes that serious observers watch closely. The structure of commodity exchanges, the influence of geopolitical energy disruptions, and the strategic behavior of global economic powers. Understanding these forces isn't about predicting the future. It's about learning how the system works, so you're not surprised when it moves. And here's the first thing most people misunderstand about markets like silver. Silver is not just a metal. It sits at the intersection of three different worlds at the same time. It is money, it is an industrial material used in technology, and it is a psychological safe haven during uncertainty. Few assets carry all three roles simultaneously. When markets are calm, silver often behaves quietly. It trades like a commodity. It follows industrial demand. It drifts sideways while attention focuses on stocks, crypto, or currencies. But when global stress starts building, currency uncertainty, energy disruptions, supply chain tension, silver can suddenly behave very differently. It becomes a pressure valve, a place where investors, institutions, and even governments sometimes redirect attention. Think of the financial system like a giant network of pipes carrying liquidity around the world. Stocks are one pipe, bonds are another. Real estate, currencies, commodities, each one carries its own flow. Most of the time the pressure is balanced. But when pressure builds somewhere in the system, liquidity looks for another exit. Silver has historically been one of those exits. Now let's talk about the second part of the title, the COMEX. The commodity exchange is one of the largest metals trading platforms in the world. But most people misunderstand what actually happens there. The majority of trading on commodity exchanges isn't physical metal changing hands, it's contracts, paper agreements representing future delivery. That structure works smoothly most of the time because only a small percentage of traders ever ask for physical delivery. Most simply close their positions before the contract expires. But when market participants start paying attention to inventory levels, liquidity conditions, and delivery pressure, suddenly people begin asking a different question. What happens if demand for the real metal increases while available supply tightens? History shows that markets don't always break slowly. Sometimes they move quietly for months and then adjust very quickly. That doesn't mean a crash or explosion must occur. It simply means that markets based heavily on leverage can change character faster than people expect. And that's why experienced observers watch the structure of markets, not just the price. Now consider the third factor mentioned in the title, energy. Energy is the foundation of the global economy. Oil, gas, shipping routes, supply chains. These determine how goods move and how industries operate. When energy markets experience disruption or geopolitical tension, the ripple effects reach almost every other asset class. Energy uncertainty influences inflation expectations. It influences currencies. It influences manufacturing costs. And those forces eventually reach metals like silver. Imagine the global economy as a massive engine. Energy is the fuel. If the flow of fuel becomes uncertain, the entire engine begins adjusting. That adjustment doesn't always show up immediately. Sometimes it appears gradually through rising volatility, shifting commodity prices, or changing currency behavior. And this is where the role of large economies like China becomes important. China is one of the largest consumers of commodities in the world. Its manufacturing base relies heavily on materials like copper, aluminum, and silver for electronics, solar technology, and industrial production. When a major economy makes strategic decisions about energy, technology, or resource security, the ripple effects travel through commodity markets quickly. This doesn't mean every headline causes a market explosion, but it does mean serious market observers pay attention to patterns, because markets are not just numbers on a screen, they are reflections of global decisions. Here's a powerful mindset shift that experienced investors develop over time. Instead of reacting emotionally to headlines, they ask structural questions. Where is liquidity moving? Where is supply tightening? Where is demand quietly growing? When you start asking those questions, you stop chasing price moves and start understanding market behavior. And silver is one of the most fascinating markets to study because it sits at the crossroads of so many global forces. It is used in electronics, solar panels, medical technology, and high-tech manufacturing. Industrial demand alone keeps increasing as the world electrifies and digitizes. At the same time, silver has thousands of years of history as a monetary metal. During periods of financial uncertainty, people naturally rediscover assets that have historically preserved value. This dual nature means silver can sometimes stay quiet for long periods, and then suddenly become one of the most talked about assets in the market. But here is the lesson most important for viewers who want to understand markets long term. Volatility is not the enemy. Volatility is information. When prices move rapidly, they are telling a story about supply, demand, fear, confidence, or liquidity. The people who benefit most from market cycles are not the ones reacting emotionally to every price movement. They are the ones who use volatility as a signal to study the system more carefully. They observe, they learn, they develop patience. Because markets move in cycles. Sometimes those cycles are driven by economic expansion, sometimes by monetary policy, sometimes by geopolitical shifts, and sometimes by a combination of all three. Right now, the world is experiencing a fascinating period where energy, geopolitics, and financial markets are interacting in complex ways. That environment naturally brings attention back to commodities and metals. But the real opportunity for viewers isn't trying to guess what happens next week or next month. The real opportunity is education, learning how commodity markets function, understanding how futures exchanges work, recognizing how global events influence resource demand. When you develop that understanding, you stop feeling surprised by market moves. You start recognizing patterns, and that knowledge compounds over time. Think of financial awareness the same way you would think about physical fitness. One workout doesn't transform your body, but consistent training over months and years builds strength. Market knowledge works the same way. Each cycle teaches something new. Each period of volatility reveals how the system behaves under pressure. Each headline becomes an opportunity to analyze instead of react. And that mindset shift is incredibly powerful, because once you understand the mechanics behind markets, you start realizing that wealth building is not about chasing excitement. It is about understanding systems, systems of money, systems of supply and demand, systems of global trade. Silver simply happens to sit at one of the most interesting intersections of those systems. That is why discussions like Silver Pump Monday capture attention. Not because anyone can guarantee what happens next, but because they highlight how interconnected the global economy truly is. Energy routes influence commodities. Commodities influence currencies. Currencies influence investment behavior. And all of it eventually shows up on a price chart. The key is learning to view those charts as the final result of deeper forces, not the starting point. Because once you start looking beneath the surface, markets become far more interesting and far less mysterious. The goal is never blind speculation. The goal is awareness. Awareness of how markets respond to pressure. Awareness of how global events influence resources. Awareness of how financial cycles unfold over time. And when you build that awareness, you stop asking, what will the market do tomorrow? You start asking a much more powerful question. What is the system trying to tell us right now? That is the question serious observers are asking when they look at silver, the COMEX, global energy tensions, and the strategic behavior of major economies. Not predictions, just observation. And the people who observe carefully today are usually the ones who understand tomorrow's headlines before everyone else does. So if conversations about silver are starting to show up again in the financial world, the most valuable thing you can do is stay curious. Study the system, watch the signals, learn how these markets operate beneath the surface. Because financial awareness is not about chasing hype. It is about building understanding. And understanding is the most valuable asset any investor, analyst, or market observer can develop. If you found this discussion helpful, take a moment to support the channel. Like the video, share your thoughts in the comments about what signals you're watching in the metals market, and subscribe for more deep dives into global finance, commodities, and the hidden forces shaping the world economy. Because the more you understand the system, the less the system can surprise you.